Today, Governor Lowe and the Reserve Board met for the first time in 2019 for their February cash rate decision. Now, that decision was to keep the cash rate on hold, but for the very first time, I suspect that board meeting would have gone longer than normal. And that's because there has been some deterioration in the economy, and I wanted to share some of that information with you in this important update. Firstly, let's have a look at the global affairs. So we do know that globally, the world economy is slowing, and we can sort of focus in on where that's coming from, and a lot of that has got to do with the political environment that we're seeing globally. So if we think about that, what we're talking about here is the US and China trade wars that are going on, the Brexit from the European Union, from UK, and just generally also about China's slowing as they obviously can't trade with the world's biggest consumption economy being the US as much as they have been in the past. Now, what that has meant is the Reserve Board in the US have certainly started to slow down their tightening policy, and they've kept their cash rate on hold. Now, that's put some comfort around bond markets and lending markets, and we're now starting to see some pressures ease in terms of costs of money for money to be traded around the world and to be lent out. The other important piece is around the economy in China. So GDP numbers before Christmas were a little bit light on, and what that has meant is that we are starting to see China looking at some stimulus, internal stimulus to try and get their economy moving, but also being very conscious about asset appreciation and asset bubble pricing in their property market. But the real developing story here is around what's happening in the domestic economy, and I want to shed some light in that because this is quite important now, because we're getting to a stage where confidence and sentiment is having a real impact in terms of what's happening in the real economy. Now, firstly, we'll try and put this into context. What we are talking about is household consumption. So household consumption makes up around 55% of GDP. Now, inside that is retail spending. Now, retail spending is a third of that number, and we're certainly seeing some very, very poor numbers being reported in regards to retail spending as households start to tighten their purse strings. So the latest data out today from the ABS was that, the commentary around that was that retail spending tumbled. By that it meant it was down by 0.4%, after being seasonally adjusted. And that certainly missed expectations where people thought it might be flat. So, that's an early warning signal in terms of what's actually happening out there. Now, around the Christmas time, we did see some news in January around CBA talking about their merchant machines and how much money they were taking through the merchant machines at Christmas, and they were light on. And also NAB did a spot survey to sort of see how business performance went, and the feedback they were getting was it's pretty tough in the retail environment. So that obviously makes for some concern. In addition to that, we obviously have seen the credit squeeze, and I'm going to come back to that in a minute, but in regards to building approvals, there is a clear indication that our recovery that was led by a construction boom is now well and truly over. Residential building approvals in December dropped by 8.4% when they were anticipating a flat result. That was in addition to a 9.8% fall in November. So in the last 2 months, building approvals have dropped 19%, and are now down 22.5% on the year and 39.1% from their peak in November 2017. Now, the weakness is across the board. It's not just in unit developments, it's also in house and land packages. So that's also telling you the impact of the availability of credit and the confidence to buy into a current correcting property market. Now, we also want to lean into consumer confidence around this story, because that's the other piece here. Now, the January result moved for the first time in a long time from optimistic to pessimistic. So it was the largest fall in 3 years, and from this time last year is down 5.3%. Now, if you actually look at one of the sub readings inside this index, which is the economic outlook, so this is consumers' view of the economic outlook for the next 12 months, also dropped significantly. It dropped 7.8%, and it's the biggest fall since September 2015, where we saw a minor correction on the stock market, and the economic news at that time was a little bit more subdued. So it's interesting, isn't it, considering where we were in that sort of mid-year, June, July of 2018, the economy was actually moving quite strongly and jobs growth was evident and everything was going well. Now, that does lead me into unemployment or employment. So some of the early indicators, because this hasn't flowed through yet to the actual unemployment numbers. And in fact, in reading the RBA statement, and why I've delayed my update today until later this afternoon, was I was really interested to see what they had to say about employment. Now, they are still quite optimistic that unemployment will reach a low of 4.75. Now, if I'm looking at the advertised job numbers for ANZ, they were coming out in January saying a fall of 1.7%, and it's the third consecutive decline. The annual pace of jobs ads has contracted by 3.7% in January, down from an increase of 4.2% in December. And it's the first annual decline in job ads since April of 2015. So yes, we had that little bump when it came into the Christmas retail period, where everyone thought that there would be a good bump at Christmas, which just hasn't materialised. Now, inflation isn't a problem for us, okay? So it's a dead duck. But part of the Reserve Board's job is to obviously bring inflation up to between 2 and 3%. Now, at the moment, it's sitting at around that sort of 1.8, 1.9. So we're outside of that, which does give the RBA capacity to drop the cash rate to try and stimulate more growth in the economy if it continues to halter like it is at the moment. Now, yesterday we also saw the Royal Commission report being handed to government and the government's responses to the 76 recommendations. Now, obviously what we saw in the Royal Commission was some distressing experiences of people dealing with financial services industries, from banks to also superannuation providers, insurance providers, and the odd example of mortgage brokers. What was disappointing about that was, considering the bounce that the share prices of the banks have had, was the decision to change the way in which mortgage brokers may be remunerated. Now, that obviously says, in terms of the smart people in town, if those bank share prices gone up collectively around 6% today, what does that tell you about, certainly in terms of better consumer outcomes? If there's less choice, the banks will charge you more for your loan. So I'm really disappointed by that, and hopefully there will be some cooler heads that prevail in terms of what happens there. Now, what does that also mean in terms of out-of-cycle rate rises? Well, we did see the banks get in just before the Royal Commission release, and we've seen several banks and non-bank lenders increasing their interest rates in the current environment. So, that is also concerning, because that obviously hits the hip pocket of the spender as well. Now, I want to circle over to business confidence. Now, I was talking about in the middle of last year that we'd moved from a construction boom and we're waiting for that business confidence and business spending, business investment to occur. And we did start seeing some of that throughout the course of the first half of the year. But then in the last quarter, and certainly the result in December, was a bit of a shock in regards to what's happened around that business confidence and also business conditions. So it tumbled in December, and we are talking a sharp correction from a plus 11 reading down to only a plus 2 reading. And this is the biggest 1 month fall since the GFC. And it was across all business sectors, and it's the weakest reading since September of 2014. So that is telling you something, that if business isn't confident, what's going on behind the scenes there. So that leads me to my point around, why has this occurred? I mean, why has the economy that had so much promise and potential corrected to the level that it has? And part of that story comes back to APRA's decision to slow down the amount of lending that was happening in the marketplace. Now, at the time, and I've said this on many occasions, that was a sensible decision. There was far too many investors in the property market, and there was far too much lending going on, causing basically asset appreciation that was happening too quickly. Now, once that correction and that squeeze took shape, and the most important thing that APRA did then was cap the servicing rate in terms of And that affects how much you can borrow. So don't worry about the speed limits they put on investment lending. Don't worry about the interest-only policies that they introduce. None of them have had the impact that the servicing calculator changes and enforcement has had. So that has been the catalyst for this correction. Now, they prevented systemic risk occurring in the marketplace, but now they could be the cause of a correction that could turn into a recession for the Australian economy. And I use those words carefully, but ultimately, you know, they need to be able to, in conjunction with ASIC in responsible lending, given the Royal Commission handings have come down, if they enforce and police lending too much, that is going to have a big impact in terms of economic activity, GDP growth, and the broader jobs for the Australian people. So, number one, APRA's credit squeeze. Number two, you've heard me talk about this before, the wealth effect. The price of your home coming down, the share market being uneasy, has left people a little bit more cautious about discretionary spending, and we're seeing that in the retail sales numbers. So that's real, it's happened. We also have seen it in terms of car sales. New car sales have also fallen off a cliff. Now, I also put down the business confidence and conditions survey down to a couple of other things. Firstly, the implosion of the Liberal Party. Now, again, I use my words carefully here. Well, no, I don't. Let's be honest, it was the stupidest decision ever to be able to sack a standing Prime Minister and to have the implosion that you did when you are the custodians of the Australian economy. So a big X to the Liberal Party in terms of the work that you did in basically disrupting the economy. Now, what that has led to is effectively a Stephen Bradbury experience where Labor are going to skate over the line and take control of the economy. Now, again, I'm going to use my words carefully here. The Labor policy, and I'm not saying Labor in general because I have voted Labor for a long time of my life, I am a big believer, a very, very big believer in giving everyone opportunity. But I'm also a big believer in making sure people stand up and take that opportunity rather than be gifted that opportunity or be handed opportunity. I mean, it is all about a fair go, but it's also about having a go. So I leave that out there. Now, it's very clear in talking to people that in terms of the Labor's taxation plans of $200 billion in additional taxation has spooked the business market. And that has also led, even though they're not in power, and this might sound a little bit ridiculous, but the reality is when you have uncertainty, you don't have business investment. And when you've got a party that's coming into power who doesn't have the same level of a record in managing the economy of late is challenging. All right, and so business leaders are making the concerning decisions of holding back. And again, I'm using my words carefully here because I don't want this to be a Labor bashing exercise. What I'm trying to say is that that is going to put a handbrake on the economy with this uncertainty. And of course, with all of these policies, positions that Labor have about clawing more and more tax revenues in to do more and more spending, isn't favourable for business conditions, more broadly speaking. So that could put some pressure on the economy as well. So what is going to be done, or what can be done to avoid going into a more deeper correction in the property market and a more deeper potential around going into recession in the Australian economy? The first things first is APRA need to now understand, as custodians of the banking system, that they may also put systemic risk into the broader economy if they don't relax the servicing calculators. Now, I'm not saying go back to where they were, but certainly a tweak of those servicing calculators would be a prudent measure to allow people to borrow money safely and effectively if they see fit, and there are obviously investigations into their ability to repay those loans meet that opportunity. That also lends me into responsible lending and making sure that the banks are able to lend money and that all lenders are able to lend money to people who are willing to borrow that money if they see opportunity in the marketplace. And finally, there's no doubt from where I sit, and I'm putting my number out there in terms of forecasting, and it's always difficult to do that, but there's no doubt in my mind that we're going to see at least one cash rate adjustment down, 25 basis points down, bringing the cash rate down to 1.25, with a potential further cash rate reduction if the economy continues to show sluggish signs of coming out the other side of this current slowdown. So, and if APRA don't do anything and lending's not taking shape, that may have to be the trigger. And it certainly helps also those of us who have existing lending to be able to give us a little bit more money in our pockets to increase our retail spending and keep those jobs alive. Remember what we were talking about in terms of retail, representing a third of the household consumption, which makes up 55% of the broader economy? Well, there's around 1.3 million people working in retail. So, we are talking about employment being the critical component to make sure we can get out the other side of this slowing economic conditions. So that's a big wrap up in terms of what needs to happen. What should you be looking out for in regards to the next big important data? Certainly unemployment information and employment data. So have a look at what comes out this month around that, and also the business confidence to make sure if it was sustained, if it was a blip based on what they saw at Christmas, or whether that's starting to recover, because those are the two big things. There's no doubt that obviously with our terms of trade and with potentially a big infrastructure program, that makes our GDP look good overall. But in terms of per capita GDP, that is about ensuring that people have jobs and they are able to live the lifestyle that they want to live. And that's very important in terms of economic activity and making sure that we have that ability to do so. Now, I understand that this is a serious message about where the economy is going and what does that mean for you personally and your personal wealth creation. But I'm going to also talk to you about how this also represents an enormous opportunity to be able to take action in a marketplace like this. We've always talked about the best time to buy is when you can afford to buy now and hold for the long term. But there are times inside cycles where the buying opportunities look even better than in general terms. And this is one of those times. But when you are looking to get into the property market, whether it be owner-occupied or whether it be for investment, there are a couple of things you need to know about the 2019 property market. The first one is, it's no longer a case of just picking any property in any suburb. More than ever, it's going to be about the right asset selection and making sure you're going into the right marketplace. So we refer to this as a flight to quality. So making sure you're in a scarce marketplace where there's strong owner-occupier appeal, you're going to do very, very handsomely over the next 5 or 10 years if you're able to take this opportunity. But in terms of taking that opportunity, don't rush in, do your research, and location selection is going to be king. All right, so we are busier than we have ever been before because our clients know that this is an amazing time to be getting into the property market. So gone is the guesswork, all right? We need to make sure that we're doing the fundamental research that's important. In addition to that, when you are competing in a buyer's market, having the negotiation skills and being, in the right market with lots of data about the market conditions in that market is going to mean that you have an unfair advantage in terms of how you negotiate and the price you may be able to secure that property for. So it's really, really important. If you are buying for upside purposes, so if you're thinking you've got a growing family or you want to take advantage of moving to a better location, these are the times where you should be considering that opportunity, because the buying opportunities are better now than what they are in a booming marketplace. Sure, you get more for your property, but you don't necessarily, you have to buy more or pay more to get into that market. Now, what you need to do is line your ducks up, okay? And aligning your ducks up, the first thing you need to do, because it is about credit first, it's always about the lending piece, you need to go and talk to your mortgage broker. You need to sit down with them and you need to have a look at what your scenario represents. Now, it could be a situation where you can retain your existing property, which is wonderful. You can turn that into an investment property and you potentially can upsize into that more significant home that you've been looking for or that better location that you've been looking to buy into. Now, if you can't hold on to that asset, then it is about making sure you make an informed decision. And my final tip in this area comes down to making sure you sell before you buy. What we don't like to see is people buying into this market and then turning around and thinking that they've had a good buy and all the good work is undone if they haven't already sold their existing property and they have to fire sale that property, and so there's been no real gain for you at all. So make sure that if you are selling, try to look for long settlement terms, allowing you enough time to then go and see if you can get out into the marketplace and buy something for yourself in that better location. So whilst I have talked a little bit about, the challenge in the marketplace, the story that you need to tell yourself and the story that the best investors in the world tell themselves is this is a time of opportunity and it's a great time to be able to get into the market. And remember, property is a long-term investment. Those of you who did get into the marketplace in 2017 and you're unsure, it is certainly time to look at the quality of asset that you have bought. But a lot of the assets that obviously we bought for our clients, from our point of view, represent tremendous long-term prospects. So if you're still unsure though, get in contact with us and we'll happily look at that information for you and see whether there's any changes that needed to be made to your portfolio. So I realise this has been a long presentation. I realise that there's a lot to digest in here, but I thought it was important that we gave you a full update in terms of where the market sits, and I look forward to sharing more information with you in updated RBA announcements every month. But you can also tune in to our weekly episode on the Property Couch at 3 p.m. Eastern Daylight Savings Time or Eastern Standard Time on Thursdays for our latest update. And if there's information that we see is pertinent to the market at that time, we will share it with you on the Property Couch podcast. Thanks very much for your time and all the best for 2019, the year that could be a great opportunity for you.